Let me quickly kick off the discussion by requesting each of you to tell me which one or two things do you feel is extremely disruptive for the financial services and how banks might be coping with that. So, Mr. Devadatta, go first.
So first of all, thanks for inviting me. Per se, disruption as a bank, we don't see as something negative. Rather, we feel that disruption, unless and until something very sudden, these are all positive for the bank. Couple of things that's happening in the market for last many years, which again we are prepared to face. One is the innovation happening. That's a positive one. Innovation happening on the fintech space, capturing on the payment process and small ticket transaction. That's a great innovation that happened in Indian banking. Secondly, another innovation which is likely to happen where we as a bank quite prepared is a AI-based innovation in banking. That something is very initial stage, but I think there is a great value when we move on the innovation. Something negative, which again we as a bank quite prepared, is something on the cybersecurity space. That's a negative disruption that can happen. All the banks are quite well prepared to face those challenges. But per se, disruption create a bit of more resilience in my system. Disruption creates bit of more slightly bank like us having 116, 17 years more agile structure. So in that way, we're quite prepared to face all the disruption in the market, at the same time create value, not only for the bank, but also for the system.
Good morning, everyone. I think since this is a student-led event, I think one of the big disruptions that is taking place is that a lot of young people, their relationship, their engagement, the number of times they communicate with the bank has changed dramatically. This is a generational change which has happened, frankly, within a decade or so, and we will need to see what happens when the students start becoming income earners, but they choose to straight away disintermediate and deals directly with capital markets. So that, I think, as an industry, we need to be able to relate to how we win their trust back, how we win their confidence back, how do we make them understand that a bank has a role and an investment has another role. It's not, not to mix the two up. Don't keep comparing FD returns with stock market returns. These are very different sports altogether. So that is one definitely, I think, which is a disruption which I think the banking industry has to start planning for, preparing for. Because it's a behavioral change. I think Saurav spoke about technological change. I think the other thing is in many payments that a lot of us make, right? There is a bank always at the back end, but you don't think you're dealing with the bank. So you take out your Google Pay or your Phone Pay or Paytm or whatever. And that has become such a ubiquitous way of making payments that the role of banks is not visible to the user, because at the back end of Phone Pay, there is always a bank and things like that. So I think the fact that a lot of users don't think banks are doing payments or banks are involved in making payments, that's the other disruption, because once again, it reduces the almost the criticality or importance of banks to how money moves in the banking system. I would say these two, sir.
I'll come back to you later on the disintermediation aspect. So I think that's very interesting to see the challenge. But yeah, so Mr. Rajneesh.
Yeah, thank you so much for having me here. As far as the disruptions are concerned, there are 2, 3 things which come into my mind. The first thing on the positive side is the IT disruption, which has happened over the last 15, 20 years, and the way the banking has shifted from normal traditional banking to the IT system. And today when we see UPI, ULI is also there, account aggregator is coming, ONDC is also there, all the Jandhan accounts, everything which has come, Aadhaar-enabled payment system, all these things, definitely a lot of things have been going towards the digital banking stuff. So days are not far off, maybe 4, 5 years down the line, There today we have a segmentation in the balance sheet where we have to tell what is our wholesale banking, what is our retail banking, and what is our corporate banking. The day is not far off. I feel that the balance sheet segmentation would also have what is the digital banking, what is the out of the total business, what is the digital book, and what is the book which is created manually at the branch level, at the brick and mortar level. This is the kind of disruption and the technology which is coming in, and most of the balance sheets are getting into digital. Now we are having additionally certain banks which are totally fintech banks, and they do not have any branches. All the journeys are straight through journeys. There are no bank branches. Some fintechs are there. So these are the things which are there. That is on the positive side which is there in the system. As far as the caution side is there on the disruption is with respect to the cyber security and the cyber frauds which are happening. That I also feel that it is a clear disruption. Disruption in the sense that we are, when we say banks, we keep money on the behalf of our clients as a trust, that whenever they want the money back, we have to give them back. And if a fraud takes place in any account, whether it is a liability account or a asset account, a cash credit or a overdraft operative account, definitely a disruption is there, and definitely it shakes the trust and confidence of the customer of the bank also, that some money has gone through cyber fraud or some kind of thing. So that is one disruption we have to very clearly find ourselves and way forward. Lot of banks are doing lot of things on cyber security in that, but definitely these fraudsters are one step ahead, and lot of things are happening. We are on a daily basis reading. That is one disruption we need to control and make our systems more agile and resilient as far as that is concerned. The third thing which is beyond IT, I would say, in today's world is with respect to the CASA. The CASA ratio which is now coming down, the entire talk about the liquidity management, the LCR and other kind of things. If you see the RBI data of December also, scheduled commercial banks have a CASA percentage of around 40% odd, and it is coming down over the years. And the other day I was reading one report, which is the World Bank report of December 2023, which states in the entire global system, the CASA ratio is only 20%. So how it pans out it as you develop as an economy from an underdeveloped economy to a developing economy, and then finally a developed economy, the CASA percentage will come down because there will be more avenues to invest as an asset class, and number two, there will be more financial literacy. So this is one clear disruption which is happening, and definitely CASA is a great challenge for all the scheduled commercial banks.
So I'll request Srinivas to make the opening statement, but I have a question for you immediately after that. Maybe. Yeah.
A very good morning to all of you. I think just taking forward from what Hitendra said, I think the key disruption which is happening is for banks is who owns the customer. Typically the banks ultimately trade through the rails which are provided by banks, but the customer actually is coming through interfaces which don't belong to the bank. More and more of the transactions which are going through the banks in terms of actually the transactions which are being put through by the banks, I think are not originated through the bank systems or from bank branches. It is coming from various other participants. So therefore the customer is clearly not being owned by the banks, but of course he's a bank customer. How do you sort of deal with such customers, and how do you make those customers provide value to banks, and in terms of in actually how do banks monetize some of those things is something which the banks need to sort of adapt to, and I think that's the process we are in. So the user interface which people use may be multiple today, but ultimately it's all going through the banks, but the customer doesn't belong to the bank. I think that is something which is unlikely to change. I think that's something which is going to keep accentuating, and the banks have to adapt to it. So whether it is there are whole issues related to that, but clearly I think who owns the customer? It's not necessarily the bank, and more it is not going to be the bank, and that's something which I think is a big change. The second is something which more internal to the banks, and being part of banks for the last multiple decades. I think if you look at every note which the banks internally put up, every proposal, everything which the banks internally do, if you look at what technology can do today, I think anything can be done in a few minutes by technology. Populating various formats, if you take any scorecard, if you take any form, if you take any proposal, if you take anything, which is all lots of numbers and some analysis, some ratios, I don't think so humans are required to do that any longer. So what are all those people going to do is the key question, because there is a judgment issue involved, we don't require so many. So if I look at it, if you sit in the corporate office of a bank, typically which a corporate office of a bank, which is primarily doing sort of MIS, data analytics and stuff like that, I think tomorrow if you just say all of you vanish, I don't think so things are going to change much in the new world. Because the corporate office is just aggregating data, analyzing data and giving the same data back to the people. Do you need those guys to do it? Well, can technology do it? I think technology can as well do it even today. I think that it's taking time for the bank. It's more a question of how do you deal with the change. But I would think that banks have to sit up and take notice that, do I need these guys here? So what do you do with the people in the bank? Because technology can do most of the work which typically, that's what I'm saying, take any form which you have, take any proposal which you have, see how much technology can populate in a matter of minutes, which possibly takes a few weeks today. I think these are the two changes.
Great. So, Mr. Rajneesh, like you raised the issue of your CASA and all. What I want to understand is the distinction between current account and saving account evaporating with the kind of technological disruptions we are seeing now? I mean, every account is linked to UPI. The number of hits are going much larger. So how does it affect your bank financials, and like what is it that you are doing as a strategy on that?
Yeah, so as I said, CASA is a challenge today for the public sector banks. Personally, I see that within CASA, saving and current account is one product which will diminish more rapidly in this changing environment, because see, when you talk about the CASA, within that current account, lot of current account in the banking system was also from the government side, both the central government and the state government, central PSUs and the state PSUs. Now with the just-in-time already implemented in most of the central government accounts and also in the state government accounts, this current account balances with the banks is now going away. Similarly, the entire working capital cycle has now within the corporate sector, also in the industry also, whether it is a proprietorship firm, whether it is a partnership firm or a limited company, they have also now optimized their working capital cycles. Less and less balances they keep in their current accounts because of the funds, rationalization of funds and other kinds of things. So current account is a bigger challenge within, if you compare between the saving account and the current account. And this current account will dwindle even further, because no one wants to keep idle balance in current account typically. Similarly, for saving account balance, there is a simple product with all banks now. Everyone wants a sweep in, sweep out account, wherein the balance, only a limited balance is there in the saving account. Remaining balance automatically at the end of the day gets transferred to the fixed deposit. So that is also bringing down, that kind of product is also bringing down the overall saving balance in the system. So banks are, all the banks, all scheduled commercial banks, typically the large private sector banks and the 12 public sector banks, are adopting lot of strategies. In fact, now the strategies, the more we are into IT, the more we are into digital, the more products we are able to give. There is a concept called the product per customer. The more product we are able to give to the customer, our saving account customer, the more engagement he will be having with that saving account. Typically, what we have seen is that any individual has 3 to 4 saving accounts across the banking system, one in a public sector bank, one in a private sector bank. And the operative account is one where the products are linked, where his SIP is linked, where his insurance premium is linked, where other kinds of payments are linked. So if you are able to have more products linked to the saving account, the more will be the transactions in the account, as you rightly say, UPI and other kinds of things. So that is the key now. Through digital and technology, we have to link these accounts, and the more agile and adaptive the system of the bank is, and the more agile and adaptive it is with respect to the transactions flowing out of the saving accounts, the more transaction will happen in the saving account, and the more transaction directly means that there will be more balances in those saving accounts.
Interesting. Yeah. So clearly, this is there now. The saving deposits, the more like the internet mobile deposits, and have you assessed the likely runoff out of those deposits in case of a stress situation? So what is it that should be done with the regard to this, because I think there's this big issue about how tight financial regulation should be and what are the costs of regulations, especially in terms of the liquidity coverage ratio. So what is your assessment how we can go about this?
See, as far as the saving fund deposit account is concerned, it's something which has not only given, it gives a huge stability to the banking system. And the product has been there for decades therein. Yes, with the increasing the digital operation part of the account, there can be volatility in that. So all the banks, we do have all the models to factor in all this runoff and then preparing a contingency plan for that. And as on today, in case we look at the volatility in the saving, I mean, I don't think it's much to look at a concern with regard to really impacting the deposit base of saving. Couple of things which are very important at this stage, why there is a lower accretion of saving fund deposit at this point of time, because the rate of interest in the market has gone up significantly high. And many of these depositors are moving to the fixed deposit market. Many of these depositors are again moving to the capital market. So this typically a scenario at which, I mean, there is a change preference leading to a slightly lower growth. But to my sense, because of the benefits available in the saving fund deposit, where you can do all the operation without almost at free charge, I think the product is going to stay. The deposit growth would be slightly lower, but then that's a critical product for the banking system and also for the entire system. Scenario building in terms of stress testing and all the banks are adequately prepared. And I don't think a scenario would happen where something like global scenario where there are some runoff on some banks on some scenario. It's going to have any materially any potential impact in the Indian market.
Okay. Yeah, please. Yeah,
I think
Mr. Hitendra.
No, I just
As
wanted
a
to just
global
share that you know, LCR. There's a lot of students in this room, right? It's the amount of liquidity you always keep with you, assuming how much money you will need in the next 1 month or so, deposits maturing, loan disbursements, and then you will take some assumptions on how much of your current accounts and savings accounts will flow out and things of that nature. But in reality, sir, if a bank is in trouble, you can keep as much liquidity as you want. But if at 8 o'clock at night there is a rumor about one particular bank, your buffer of liquidity will evaporate in half an hour. Okay, so unless you ask banks to keep all their liquidity all the time available to meet all the outflows, it's a very complex issue, because in this day and age, with the WhatsApps and everything else available, if there is a rumor, then the amount of liquidity you keep is totally irrelevant. You can make it LCR of, like, you know, you can say for digital accounts keep more because they can be digitally, but we have 24/7 RTGS. Any corporate can withdraw money at 3 a.m. in the morning. Any amount, there is no capping of the amount they can withdraw. So I think when we design regulations, we need to be real context of the how can you even react to that speed if it's 3 a.m.
So now the elephant in the room is out. So in the sense that I think very nicely explained the concept, because they are students. The liquidity coverage ratio is about what you have to keep in high quality liquid assets to meet the liquidity outflows in a 30-day stress period, as you may see from the past data. Now, the past data won't tell you what's the future first. So that's one issue. And as Mr. Dave has very cogently argued that the deposits can just fly away, and all of them can fly away, then there's an issue of trust in the banking. If that is the case, we need to really solve this, and we need to have a clear dialogue between regulators, between banks, between academics, industry, to really think how we can deal with this problem. It's a very serious problem. Just because it hasn't happened in India, it happened in SVB case, is something that doesn't give us much comfort. So we really need to work out. Are you sort of advocating that there should be some limits on the deposit withdrawal, which itself will erode the trust? So that cannot be done?
No, all I'm saying is there is an overarching assumption that you keep a high LCR or keep higher outflow assumptions, and the problem is solved. The problem doesn't solve. Just imagine, we are in 2025. When the financial crisis took place in 2008, if we had the level of digitization that we have today, right? The weekends over which all these people were negotiating, US Federal Reserve, US Treasury, they wouldn't have had that luxury because, everybody on the phone would have withdrawn. So it's a very all models have to incorporate the speed at which money can move out. India is one of the few 24/7 RTGS markets, right? And to your point, sir, it's not happened in India is because we've not allowed it to happen.
Yeah.
So in a way, conservatively run banks have no advantage over adventurously run banks because the central bank has provided a put to depositors, and therefore depositors don't go to extraordinary lengths to say Bank of Baroda is a very good bank. Even if he pays me lesser interest, I will keep with him because you don't, if he's giving 6 and somebody is giving 9, nobody is doing the fact that 9 reflects a higher level of credit risk. Indians are not used to the fact that the banking industry has credit risk.
Yeah, I just want to supplement this. I think what Hitendra said is totally true. I don't think so we can provide or plan with whatever model for a situation when public loses trust in a bank. I think what the regulator is trying to do is to signal to everyone that every bank is conservative. They have enough money to provide for deposits or outflows over the next 30 days. So they are all in a great shape, and therefore all of you can trust the bank. For whatever reason people don't do it, nothing can be done. The only thing is that right now, everyone has to take comfort that RBI has made sure the system is robust enough and not let it slip, and therefore they will take care. So the put option is there, but trying to excessively stress and trying to sort of model and try and put excessive regulation in terms of trying to manage for such scenarios doesn't help the bank nor the real economy, in my view.
Can I just add one point
Okay,
here?
sure.
See, there can be flight of deposit that can happen, that's real, right? But then if you compare the Indian market vis-a-vis the global market, the resilience of the Indian market is much high because of a high reserve requirement. We operate globally, nowhere we have a reserve requirement which provides a huge stability to the market. And that's the strength. A scenario which unfolded overseas, the probability of happening in India is very remote. That's the take.
No, I couldn't completely grasp why you think. Is it because of the put or something else? So
The put price is this.
the put price is okay.
If I can just add on this with data, see, like we are operating, Bank of India is operating in 15 countries, different countries. The LCR ratios in those countries ranges from 100 to 20. So in one country, there is only LCR ratio by that regulator at 20 only. In one country, it is 40. And there are a few countries which had 100, like we have 100 over here. So the different things are, the LCR is different at different places ranging from 20 to 100. But beyond that point, which I would like to make over here is we, in our country, like we have a SLR and CRR also beyond that. So we have a SLR of as on date 18% and a CRR of 4%, which means 22% of the cash which is deposited or the bank deposit is parked with the RBI and through SLR and the CRR. So having said that, if you see the SLR and CRR kind of thing in other developed countries, it is not there. And even if it is there in some of the countries, it is at a very low level. So already our deposits are cushioned in the fact that 22% is parked with the Reserve Bank of India. So that is something which is clearly, and you can see it with data also. If you take out the data for all emerging economies and developed economies, what is their CRR and SLR is there. So that is one very important data point which should be kept in mind before deciding. So presently when RBI is having a LCR of 100, and all banks have kept their internal threshold much higher. Some have kept it at 115, some have kept it at 120. And I do not think any of the bank has gone down below the level of 100.
So Rajneesh, that's a fact that our regime has 100. I think every credible regime has LCR of 100 or more. So let's not talk of those 20s and 40s who have not kicked in the global financial regulatory reforms. So we are in a kind of a globalized country. We aspire to be advanced economy and stuff. So we can't really pull back regulations to that extent of weakening the LCR. But I see your point about SLR. And this was something I was asked on the Business Today conclave yesterday, where Dinesh Khara was there. And my answer is very simple to this. I mean, one would like to dispense with SLR over a period of time. If you have LCR, it's practically you have the liquidity. But the essential thing is we need more fiscal consolidation, more fiscal reforms, because you are essentially doing a financial repletion by having these instruments and directing credit to the government out of it. So let everybody compete for the funds and credit, and where the returns are, let the market efficiency prevail and get to that. But till such time that is possible, I think already the SLR has been reduced and converged to a level, some reasonable thing. But the LCR problem is more dynamic. I mean, it's something which could really come in a big way. I don't know if your bank is toying with tokenized deposits. Are you toying with tokenized deposits?
Sir, we've been evaluating that subject for a while. The broader subject of the entire tokenization, crypto and all those things, at this juncture, as an organization, we haven't taken a definitive view. But clearly, for example, with the Reserve Bank of India really trying to promote the central bank digital currency, right? You can make out that the position of RBI till fairly recently has been very clear that that's the only digital currency which will be permitted in the country. But on tokenization, we have started some tokenization efforts around the world, gold, and you can acquire some other things. But we are still backing conventional asset classes as opposed to new generation asset classes.
So that's where the difficult part is. And I'll come back to your first question, because if tokenized deposits are coming, if we can't even handle internet and mobile deposits, the tokenized deposits with programmability could really cause a flight of deposits in macro nanoseconds. So then how do we deal with that? I mean, where are the regulations to handle that? So it's a really mind-boggling question. And the future of banking could get at stake, and I would rather come at this level to discuss the first question you raised, vis-a-vis capital markets. And Srinivas is from capital markets. In earlier days, you had that role very prominently. So is it that the pace of disintermediation will now increase a lot more, or are banks doing something to deal with this challenge?
No, I think the one thing is, like I said, all the young people have only seen one-way markets, right? You put money in the market and you make money. They haven't experienced anything else. So it feels very silly to take a deposit paying you 7% after 1 year when you are used to making 7% overnight or in a week or something. So and that is one. The fact that India is a young country has many advantages, but one of them from a banking system perspective is adoption of digitization, new trends is much faster than in many other parts of the world. We observe that Indians are embracing change a lot more faster than in many other parts of the world. Second, like I said, you see Japan, for example, had 30 years where the stock market didn't go anywhere, right? Now, nobody's wishing that on Indian stock market, of course. But you do need people, as last 7 months, we are already seeing some flight of deposit back, because people have put money in the market and lost something, and again reinvested and again lost something, and again. So therefore, I think people will begin to distinguish between what is a 100% guaranteed product, right? Bank savings account or deposit is a 100% guaranteed product. While anything, even in a debt mutual fund, the prices can go up and prices can go down. So I think we haven't done a great job as an industry of distinguishing ourselves, right? Mutual fund sahi hai, mutual fund sahi hai. Which bank said banking is also sahi hai? Right now we should be out there, no? Saying that you put so much money on September 30, it is worth 85 rupees today, right? But my money is 101 rupees or something. So I think we are a slightly reticent industry. Over a period of time we get used to it. But I have confidence that so long as people value the safety of their money, banking will have a role to play. It's just that we'll have to discover how to communicate and how to almost position banking as a service.
No, I have my heart with the banks. I mean, banks are unique. They are the ones who create money. So I have some sympathy there. And to put the numbers correctly, even today, the financial savings of the household, 30% are bank driven. It's 8% for the MFs and other equities. So that's the share of financial assets in the portfolio of the households.
I think whether mutual funds are here or banks are here is one question. I think we are believing that all of these are push products, meaning people are buying this because someone is selling it to you. I frankly don't think so. I think if you look at any retail investor, even if he's not sophisticated, clearly I think he has a view in terms of what gives him reasonable return for the risk he's taking, and that's why if you see whatever has happened, if just look at plain gold, I think the amount of money which has gone into gold from retail investors, forget all the buying gold as a jewelry or buying gold as a thing which you typically do. The trend changes. If you look at last month's even mutual fund thing, the gold ETFs have been seeing the biggest spike. So the point I'm trying to make is that the use cases should be relevant for the investor and he should find that useful. Equity markets, whatever, has happened. And again, the asset allocation of equity in everyone's portfolio was so low. Even though markets have not performed, I think it's willing to stick with it as of now. Meaning incrementally there may be some adjustments. But what we need to see is that fixed income products are actively discouraged by the government in terms of taxation. So if there is a huge benefit in terms of post-tax returns on some products versus something else, the hurdle rate at which they will come in is going to be much higher. So unless you need capital protection, you'll not come to a bank FD. Only if you believe I need capital protection, and that is as you grow older and stuff like that, I need capital protection and therefore I need to go to a product which returns are not something which is important for me, but I need capital protection. That's the time you'll go into a bank FD or a fixed income product. Because the post-tax returns are skewed in terms of products, and that unless you level that up, you cannot say the asset allocation from an investor side is wrong, and therefore because someone is pushing something harder, it is working. Mutual fund say was there even before. Of course, the amount of money they're spending because they're making more money is only gone higher, but the campaign has been running for a much longer time.
So, okay, let me turn the track on a simple footing now. From your personal lives, maybe one or two of you can answer. Has AI, machine learning, improved in MIS from the perspective of a CEO? So from the CEO's angle, do you have to now monitor a lot more information, though digitized, and are flooded something which you can't read? Or does the AI or the ML enable you to see things where exactly you want to focus? So this is, how do you eat the elephant in the room in your bank?
See, there was a question earlier also, is technology and employment, there was a question earlier. Actually, the fact of the matter is that technology is not going to reduce employment per se, it's going to improve the quality of job. And that precisely for a CEO also, when we look into, there is a huge data, like 10 years back, I never would have thought that the entire approval process, as far as I am concerned, is through a paperless work. I mean, file doesn't move to me. It's through entirely a paperless approval system. I cannot think of like, suppose I want to interact with all my regional head in half an hour time, I can very well touch base with them with a Teams network or some other network in half an hour time. I cannot think of a scenario where the decision support system to act on a particular issue, there is so much of MIS backup, so much of data backup in case I want something to be given to me, it is given immediately because of the usage of AI and ML. So hugely the life has changed as far as the CEO perspective. And the important part of the technology which you believe is that it can improve your quality of job, at the same time significantly improves the productivity. So we take it in a positive in terms of how do you look into technology and banking, and for a CEO perspective is very, very important. Everything I look at my own product process, anything I look through the technology eye, and that's completely churning in terms of the way the delivery is happening at the ground level. So I think it's a very positive one. It gives a huge comfort that you are making the right call, right decision, using a huge efficient process as compared to earlier.
Is AI lending a risk at this juncture? Are you having correct information based, if you depend completely on AI? Is lending a risk?
So important question on AI. Before I answer this directly, just on the AI ML, all banks are investing a lot on AI ML. And our bank also has done a lot of things on data lake project through the AI ML, and we have this project called the Star Aditya project, in which we have a dashboard coming to each one of the leaders in the bank, which we call a click. In the click, what happens is that the entire data every morning comes to us. In fact, it is 24/7, the entire bank data, and I can modulate the data which I want to see as a MD and CEO. If I want to see the total business, if I want to see the run rate at which, weekly run rate of the personal loan which is getting disbursed in the bank, that also I can customize myself that I want to see on a daily basis, that kind of thing. Similarly, we have customized it down up to the level of the branch heads. If he wants to see what business he is having, what kind of disbursements are pending, what are sanctions in the branch which have been sanctioned, and what is the disbursements which are pending in those sanctions, he can see with the click of a button. Similarly, for the zonal head, the FGM, and the general managers at head office, the CGM, the executive director, everyone can customize the data which they want to see under that project, which is the data lake project.
Yeah, that's fine, but
yeah.
but the quality, the risk, the
So I'm coming
risk
to that,
profile
yeah.
of the person to whom you are lending.
Correct. So when we are going for digital banking through the AI, the algorithm which is there, it is something which is very important to check the algorithm and double check the algorithm. What we are doing in our bank is that once the sanctions also are taking place through the channels, which is the digital channels, our audit teams and other teams are also validating the sanctions, whether the rule engine is correct, whether the algorithms which have been set is correct. If we have given a CIC score of say 700, we cannot do a personal loan with below 700. Has any loan got sanctioned which is below 700 CIC score? All these kinds of data checks we are also doing, back testing we are doing to just to check that. I fully appreciate that there have been some cases where there have been some misses which have happened through the system, where some misses have definitely happened through the system, and it is a learning process for the entire system, banking system, whether it is a bank, whether it is a NBFC or other fintech company which are going through these digital channels. So we need to have customized things under the audit to backtest our data which is coming after the sanctions and after the disbursements, whether the algorithms which have been put in place are robust enough and they are agile enough and they are catching up as per the metrics which we have put in the system.
So the worry which I was slightly having was, see, the banks don't seem to have information for working out the expected credit loss. Not all the banks have enough data for that. So the advanced approaches you can't depend on, and you have to have standardized approaches and stuff. Now, with this kind of data, would AI be throwing good quality data on the lending quality? I mean, if we can't introduce ECL framework and we are moving to complete dependence on AI, where do we end up with?
As far as ECL is concerned, the banks do have the data. Actually, the banks have been preparing themselves for ECL almost many years from now. And the right sizing of the data and the quality of data available as on today. So in case the system decide to migrate, the banks are quite capable of migrating and managing that. AI typically helping in terms of the decision support that you have scenario building and then telling you what is right. Like there is a quiz and one particular item has a higher take. So the usage of AI is that when it supports the decision, it is also supporting you in terms of the probability in which your decision would come right. So I think these are maybe related, but then banks are prepared. There are almost 15, 18 years of data now with the banks here. The advanced approaches on the capital is not because of data per se, because of the quantity it captures the capital. That can be one issue, but otherwise banks are well prepared.
Thank you. Let me change the track a bit. None of you have mentioned climate finance as a disruption. Globally, I think that's one big disruption which is coming. Maybe Hitendra would be the right person to tell us how is it causing disruption or not disruption in the Indian environment.
No, I think it's a very good topic you've introduced, sir. And I think again, there are cities which are getting rains when it never was supposed to rain, and when it rains, it's hot. And while that's news for many of us, for banks that have lent in that city, right? Whether your factory gets submerged with water, or for many people who are earning daily wages, the daily wages have gone to zero. So I think globally, most banks have tried to introduce this risk element into their decision models. Is it as advanced as conventional credit risk assessment? Obviously not, right? Because the climate change, there is not enough golden sources of data almost, but I think just given the sheer amount of change, we had extreme heat last year, right? I mean, that caused an economic slowdown. Now, how do you factor that into your model that an economic slowdown causes lower employment, or it has increased sales of air conditioners, for example? That's also the upside. So at this juncture, at least I am aware that almost all global banks have climate change specialists sitting within their risk and operations team. These people do provide inputs, but it is not like if you are selling steel, okay, this is the cost of steel. If it falls below this price, then the operating cash flows will, it's not gone to that level, but I suspect as climate change is felt by all of us more and more, it will be introduced. But the interesting point is, given the change stance of US on this, we will have to see how that flows through regulations and Basel 3.1 and other things, etc. And at a broader level, the one-way street that regulations and regulators has been challenged now by the US administration, and it will be interesting to see its adoption. There are Basel standards which are now live in Asia, but not in Europe and America.
Okay.
So we'll have to see how that flows back.
Great. So would you want to add to that?
Yeah, I agree. I think we should not look, I think tendency has been to do this green finance bonds and green, all these are, I don't think so. There are pools of capital which is available, which may be there, may not be there, depending on how the world looks at climate finance. But what is key is that it should again be something which people believe has to be factored in for doing business. It should be incorporated in a way of doing business. If I do this, I have an issue. If I finance an agri thing here, the risk has substantially increased because of change in weather patterns or something. Clearly, the use case should come, like what Hitendra is saying, in terms of it being looked at as a risk for doing business. If I do this industry, I have increased risk because of certain things. These are things which need to be built in, and that's when I would think money will not go to certain pockets which should not go, and will go to certain pockets which are useful. So I think we've not got there. We've clearly not got there. We are looking at this as more as saying, I'm doing renewables, therefore can I raise some cheap fund money under a different row item? I think that is being very short term.
Yeah, but the greenium on the green bonds is fast disappearing. So it's
no reason for it to be there. I don't think there's any reason for it to be there.
So does that worry you? No, not at all.
Meaning, if you actually do the right things as a business, I think it will come back.
Okay. And any of you planning green deposits?
Yeah, I do have actually a green deposit, and the outstanding deposit in this particular scheme is very significant. Maybe as on today, I think the highest deposit, green deposit, is there with Bank of Baroda. That's the data which available now. So it's not the
So what is
premium.
the differential you give on that?
There is no differential. That is what the point I'm driving. So this deposit at par with a normal deposit, actually the concept at which the depositor, at the concept at which the issuer, like the bank, were attached to the concept, and that possibly driving the deposit to go significantly.
This is really music to the ear because I can understand why green bonds are sort of by the investors. I mean, there are funds which have a clear mandate now not to give funds except for the green. Biggest funds in the world.
I tell you
but deposits coming from the retail level you are getting or the corporate level?
It is on both. Actually, the advantage is that there is a disclosure requirement with regard to how much you have invested into green bond or green deposit, and that possibly driving a significant pickup there.
Okay.
If I can just come in over here, we also have that green deposit, and just an interesting thing that we are getting query even from the corporates for that. So what has happened the moment we launched and we went to the corporates also that we have green deposits, there were many queries also what extra rate of interest you will give and other kinds of things. In fact, now corporates are mentioning in their balance sheet how much they have invested in green deposits. So in fact, if you see our book, our retail deposit from retail investors and the corporate depositor is both equal. So that is the kind of thing, and that is the kind of the interest which it is carrying now these days, green deposit.
Okay. So maybe last two questions. One, how are you, which areas of the banking you are implementing AI more and which less? I mean, as I said, there's elephant of the room. You either eat it or you then basically perish, to be honest. Or if you eat it and then do you eat it in parts? You have to probably not incorporate the whole AI immediately. So which are the segments which are driving the AI investments in your banks?
I'll give two statements here. One is that on the risk management and fraud risk management underwriting, there is a usage happening for last many years, established now. The incremental part that we are using AI is on the relationship side, not to market, but then we do have a virtual relationship manager, which is Aditi, creating a global buzz also on that particular relationship manager, which is covered by Gartner. Microsoft CEO talked about that. So that's more on the relationship side, making the customer experience much better as compared to the past.
Okay. You wanted to add?
You know, I just wanted to mention again, I think, for example, we have fed in the entire FEMA, all our historical experiences of what RBI approves, does not approve, because there's lots of rules and there's this. So I think, for example, now when we get a FEMA query, it's much easier for our teams to be able to just say this will go through or not, rather than say, let me go to the RBI or come back or not, because we have historical, and the second thing is, for example, on our credit policies, we have made our AI engine digest all our credit policies, so the RMs know that whether specific types of loans, etc., will be approved or not. So I think you can make it micro or you can make it macro, whichever way you like it. But I think the sense is most organizations are not 100% in, nor are they 100% out. We are all discovering how much of AI we want to incorporate into which part of our daily and management routines.
My last question, how do you see in this disruption the next generation of banking reforms should be, how should they be shaped? Not that the first generation has been fully implemented, but they have been reasonably implemented. There are misses, there are positives in that. You had public sector bank consolidation, 27 to 12 or something. And do you see further consolidation in the banking sector coming with this threat of disruption, which will obviously put competition very high with the securities market firms and others? So what are the key points there?
I think one thing which is, which even from the previous cycle, which we should learn, which possibly is most important as we go forward, is that as all the CEOs are saying, the amount of investment which is going into technology, cyber, or AI is mammoth. And each bank is spending thousands of crores, if you put it lightly. And almost all of them are doing the same thing. The areas of focus are broadly fraud reduction, risk management. Well, we can list out the areas, but I would think the areas are broadly the same. I always wonder, is there a way to have a service or a tech stack architecture which is owned by the banks, which of course they can customize to, meaning you got a off-the-shelf product which they pick and they customize it for whatever they, because I don't think so we can afford investments of this scale, bank after bank after bank. We need to.
But the nature, the future of finance would go into a differentiated lending.
I'm saying that's what you have a stack.
I mean, they will customize to each customer and deliver on the doorstep the financial services.
Right. You have a tech stack which is on the shelf, but you take it and customize it. When you look at what does every IT firm do? They have a set of off-the-shelf products, and you say, what do you want, and then they will customize it for you.
Okay.
So I'm not saying the bank just does whatever has been given to them. You take the core product, core architecture from there, and customize it for what you want to do for your customer. But everyone investing in that core architecture, everyone investing in the backbone, everyone investing the multiple thousand crores, to me looks like no one's going to go to get the ROI. To me, it looks like for the ROI and the investment across banks is going to take a long, long time. So we got to look at a different model because a lot of this is uncertain.
Fair.
You don't know the returns. You don't know when the returns are going to come.
Fair point.
We need to see, so the ability to take punts on what can happen is a lot higher if people can work together.
I guess that's why multi-factor productivity growth numbers are so low, because the returns would take quite a while. How many, do you think public sector banks should be privatized below 50% holding? Should there be further consolidation?
So see, consolidation is something which the government has to decide finally, but definitely on the point of view of the equity capital percentage of government, yeah, it can be definitely brought down to a significant level, definitely, because in future there will be requirement of capital as the banks are growing, as the economy is growing, more capital is required. The percentage of Government of India holding definitely can come down.
Any governance?
Yeah, no, I think banking, as we all know, is a unique business, right? There is no other organization in the world where you will give your cash and feel safe about it. Nowhere else in the world will you disclose your salary, but not even your wife knows, but the bank teller knows what your salary check is and all that. So it is a unique business, which I think many people don't actually appreciate sometimes, except regulators and the regulated many times you feel, because you're able to create credit, right? I mean, you're able to create money, which is a magical power given by the license to operate as a banking unit. And therefore, if there is an index of governance, the governance in banking companies or banks needs to be at the top end of that index. You can't even be second best, because you are dealing with a very unique institution which is licensed to create money, and therefore, because you are licensed to create money, the regulations always have to be super tight and super good.
Last word, quick, short one.
No, I mean, there's absolutely a stakeholder call with regard to merger and consolidation. And as on today, if you look at the 2 rounds of consolidation, the banks have achieved a significant scale. And they're adding also significant profitability in that way. So for the scale to add further efficient, actually that's a time only would tell, and the stakeholder would take the call on that.
Thank you. Thanks for the wonderful thoughts. I think we'll end us here. Thank you.